Okay, I think this works now. Hi, good afternoon, everyone. My name is Kevin Ye, Uncle Kevin. I'm the founder and financial advisor at Daberistic Financial Services. Yeah, I can hear myself now. And sorry for the delay. We're supposed to start at 12 o'clock, but because of technological challenges, with the security and the various streaming services. We're sorry for the delay, but I'm very pleased to have Amika Gordhan from Coronation. She's an investment specialist that's just going to talk to us about Coronation and the investment market. Amika, how are you doing?
I'm fine, thank you, Kevin.
Good to have you here. First of all, I've worked with Amika. She's been our consultant for many years. And I know that right now there are many clients, investors asking questions, especially with the investment markets. Right now, there's a lot of uncertainties, things going on. And I just thought that it would be useful to hear Coronation's views on those investment, on those themes. And as a lot of the investors are invested with Coronation, and Coronation being one of the largest fund managers in South Africa. So Amika, without further delay, I just like to pose those questions that I have discussed with you. And obviously, you're welcome to just also share with the audience about Coronation in terms of these specific funds, how they have performed over the last 12 months, and maybe a longer term, just to give an update on those the performance figures. But first of all, is that given all the news flows, we know there's a lot of things on the go. There's a month ago about the Russian arms debacle, where the U.S. ambassador to South Africa accused South Africa of providing or selling arms to Russia. There's load shedding. There's interest rates at the highest level in 14 years. Then we have inflation that's not abating, maybe abating a bit. The rand at the record lows, touching almost getting to about 20. And lots of negative news. And how does Coronation invest its clients' money and position its portfolios?
Thank you, Kevin. And thank you firstly for the invitation. It's always a pleasure to join one of your masterclasses and get a chance to interact with your investors. Look, I think when it comes to how we construct our portfolios, probably one of the most important points that we anchor off is to never position our portfolios for a single outcome. We often refer to building what we call robust portfolios, and these are driven by differing factors over time. And that really does become, very important in a world with so much uncertainty. Now, you've listed quite a laundry list of issues facing not just South Africa, but the world. And I think the point I want to drive home is that we do an enormous amount of work around the challenges that you described. We are acutely aware of these difficulties, like I said, not just here in South Africa, but around the world. But at the end of the day, I think what is really important to understand is the job of an asset manager is not to avoid risk, but rather to adequately price it. Now, what this means is that we are out there trying to buy assets when they are cheap, as they offer investors a high degree of margin of safety, right, for lack of a better word. And we know that often when times are exceptionally dark and you have increased pessimism, this often results in very low prices. And currently, the valuation of SA equities, for example, reflects all the negativity and concerns investors have. And we think that's actually where the opportunity lies. Another very important consideration is that when it comes to portfolio positioning, SA equity makes up a sizable allocation across our flagship multi-asset portfolios. And when we scrutinize the components or the construct of the JSE, what we observe is that the JSE is not reflective of the SA economy. More than 2/3 of the JSE today is made up of shares that are not reliant on the SA economy. There are businesses which are called multinational dual-listed businesses. So these are stocks that are global in nature, but they happen to be listed on the JSE, like Naspers, British American Tobacco, Richmond. And then you also have the commodity stocks like an Anglo American and Glencore. So if you consider a portfolio like, let's just say, the Coronation Top 20 Fund, this is a fund that can only invest in JSE-listed stocks. So it is, by definition, an SA equity portfolio. However, when you scrutinize what that fund looks like, you'll see that only 29% of the fund is exposed to what we call SA Inc. stocks. And these are businesses that are directly exposed to the SA economy. This means that the bulk of this portfolio is invested in those multinational stocks I mentioned, together with commodity stocks, which are very constructive in a world where, we're very constructive on in a world where there are growing supply deficits and growing demand as well. So I think when we put all of this together, the message very clearly is that we are aware of these risks, but at the end of the day, what is a more important determinant of what we buy and how we position our portfolio is price. And negative news and negative sentiment result in cheap prices that most asset managers actually get quite excited about.
Right. So I understand what you mean, what you talk about in terms of valuation and that. But if I look at the recent news flows from the big corporates in South Africa, like your Pick and Pay, your Shoprite Checkers, Spar, Woolworth, etc., and everyone, and Vodacom and MTN, everyone is spending so much money on dealing with load shedding. Spending more on the diesel and the generator and whatever the solar or the energy solutions. And that's really going to hurt the earnings for now. So you don't think this is a long-term phenomenon, that rather after maybe the pain for the next 2 or 3 years, that things are going to normalize?
So look, there's definitely a lot of that playing out. You're seeing earnings updates coming out that are worse than what most people expected. It's worse than what the companies themselves expect. And that primarily is driven by the difficult macroeconomic environment in SA. And stage 6 load shedding at that kind of intensity has contributed directly to the difficulty that corporates are facing. And look, one has to have a view on what load shedding is going to look like in order to determine whether there's going to be any relief in terms of the earnings prospects for these businesses. Now, what we do an enormous amount of work around load shedding itself. And we've done over 700 channel checks over the past 2 years. And this is talking to not just CEOs and CFOs, but staff, previous employees, industry experts, just to try and get a sense of what impact load shedding is going to have on these businesses in terms of their long-term profitability. I think the point we also make is that when we value businesses, we do take what we refer to as a normal earnings cycle. So we don't just look at this year or the last year. We try and forecast 5 years out and try and make an assumption around the various factors that are going to drive those earnings. So without a doubt, you can see clearly that pure SA Inc. businesses are really, really being impacted by just this one part of what's playing out in the economy. But I think therein lies the opportunity to get your stock picking right. So not all businesses are impacted equally by load shedding. And what we observe is that the strong businesses will get stronger and the weak businesses end up being even weaker. And how any SA Inc. business is going to survive in this challenged environment is that they are going to eat the lunch of their competitors. And there are still great businesses within SA that are demonstrating a huge amount of resilience. So you get a stock like Dis-Chem, which is growing its earnings at 16% per annum despite load shedding. But it is without a doubt taking away market share from the smaller independent drug pharmaceutical businesses. You have a business like Pepco, which continues to grow its footprint, is targeting an attractive LSM. Consumer spending is without a doubt under pressure. People are spending less, but people are also migrating down the cost curve. And you have a business like a Pepco that has grown its market share fantastically. And that has come at the expense of a business like Epcot, for example, which, we've all observed its demise over the last 2 decades. So within each sector of the SA Inc. space, there are 1 or 2 players that are still profitable, that are still growing their earnings. And like I said, not all businesses are created equal. Some businesses have got stronger, better balance sheets and are able to withstand the cost pressures better than some of the weaker competitors. And that's how we have to go about identifying within the SA Inc. space which businesses are going to be more resilient and survive and which ones aren't. And I think the one part of the SA Inc. market that we actually find very attractive at the moment is the SA banks. Now, arguably, from an operational point of view, SA banks are less exposed to load shedding than, say, a food producer or manufacturing business. A lot of businesses transact digitally and online. And so, the operations of a bank are not that exposed to load shedding. The flip side of the equation when it comes to banks is that they actually stand to benefit from all of the funding requirements that will come through as more and more corporates, households move towards renewables. So there's tens of billions of rands worth of funding that the banks are going to be participating in, and it can actually be quite profitable for them. So again, you can see you have to break down each sector, each stock, and see what impact load shedding is having on that business and on that sector, and try and identify the winners within each of those categories. Because like I said, not all businesses will behave equally in this economic climate.
Right. Now you talked about banks. I just want to talk about more about banks and the load shedding, because I think the last 2-3 weeks, there was talks like, what if South Africa suffered a total blackout? And then I could only imagine like the whole financial sector is grinding to a halt. No one can use their bank cards, and the banks, they cannot really function. Without electricity, the banking system won't work. Has Coronation posed such questions or scenarios with the banks? And what's the bank's response? Should even right now, we don't wish for that unlikely scenario of a total blackout?
Yeah, so I think this is not unique to just the banks, but obviously the banks form the center of of all economic activity, be it from a transactional point of view, just having to be able to pay for things, draw cash, and all of those things. And I think each business, particularly the banks, because they're so fundamental to the operations of the underlying economy, will be implementing some kind of disaster management process to get the most important systems and people into a situation where they are still able to operate in such an environment. Even taking Coronation as an asset manager, where clients will be, transacting on a daily basis, withdrawing, investing. We have to be able to transact, and we have to meet our financial obligation to these clients. And even our business has got contingency plans in place in order to be able to get core staff and core systems operational under the worst case scenario. And like you said, no one wants this to happen. It really is not ideal, but I would imagine that each business, especially those in the financial services sector, are gearing up and preparing for that outcome and making sure that they've got enough plans in place that should this happen, that they can still operate and fulfill their obligations to their clients from that perspective.
Right. Okay, my next question comes to Coronation Balance Plus Fund. I think it's the second largest balance fund in South Africa, just behind Allan Gray, and that fund has served its investors well over the years, and it's used in the retirement savings solutions. Right now, with the Coronation Balance Plus Fund, does it max out its offshore exposure, or does the portfolio manager consider taking some currency profits? So
look, last year in February, National Treasury announced relaxation in the Regulation 28 limits to allow these funds to go up to a maximum of 45%.
Yeah.
We have increased our offshore allocation quite materially over the course of last year, but primarily because of the very attractive opportunities we found in the sell-off that we experienced in both global equity and global fixed income markets. The change in limits obviously allowed us to take advantage of the opportunities in a much more meaningful way, because we were able to implement our views to a greater extent, having more flexibility to take our portfolios higher in terms of offshore. So to demonstrate the extent of the shift that took place within the Coronation Balance Plus Fund, if you go back to January 2022, the total offshore exposure in the Balance Plus Fund was approximately 23%. We ended 2022 at about 40% of fund. Sure. And today we're actually slightly beyond our maximum. We are at 47% total global equity exposure.
Wow.
Sorry, total global exposure. Now, the weakness in the rand has meant that offshore exposure has drifted higher in the last couple of weeks, but that's where we sit today. Now, we've not taken currency profits despite the very weak rand that we've experienced. And that's because we believe that the valuation of the offshore assets that we hold are incredibly attractive and very compelling. And we continue to believe that they will deliver attractive returns for the portfolio, together with providing much needed diversification for the investor. Now, we've talked a lot about load shedding and, perceived association or support for Russia and the weakness in the rand and all of these issues that are plaguing South African investors. And we think that change could not have come at a better time, because it really gives asset managers more tools in which to deploy proper diversification for clients. So we welcome the change. We are at a full allocation within our portfolios, but the primary decision to move that portfolio higher into offshore assets has been valuation and will continue to be valuation. And we think that those assets are quite attractively priced today. And like I said, offers really good returns over the next 3 to 5 years. So we're quite comfortable to keep our allocation as it is at the moment.
Okay, so I just want to follow-up question. In terms of the Balance Plus Fund, do you have a strategic asset allocation saying now that with the relaxation of the offshore limit, that Coronation's position on this fund is you're going to have, say, 40% or 45% offshore exposure, or is it going to be flexible depending on the currency, depending on the valuation? It can increase or decrease quite substantially?
So look, if you look at research suggests that the optimal offshore allocation for a pre-retirement client, which is where a lot of clients would be investing in Balance Plus, is around 40%. Now we are at the top end of our allowed offshore allocation, and that is because of valuation. So like I said, valuation is the primary determinant of how much offshore exposure we have. And if global assets continue to run and we want to take profit and we believe that the valuation no longer supports having such a full weighting to offshore, we will bring some of that back. But valuation by and large is the key determinant in terms of how much offshore allocation we will have. So we don't set a specific target for how much we will have. It all depends on the price of the assets that we can buy offshore relative to local.
Right. Okay. But having said that, would Coronation foresee in the future where the offshore exposure on this fund to ever go back to the previous level of 23%?
Yeah, so look, I'm never going to say never, but it is more likely that with the extra flexibility that portfolio managers, and not just unique to Coronation, are going to have higher exposure to offshore assets. Remember, at the end of the day, better flexibility is better for the client, because like I said, you have more tools at your disposal in order to give clients the best risk-adjusted returns over time. And it's not just global equity. So with the repricing of global fixed income assets, we now have a separate line item called global credit in the balance fund. It makes up about 5 or 6% of the portfolio. That exposure didn't exist 18 months ago, but we're finding newer and newer opportunities, again, to give clients the best version of our balanced portfolio over time, and give them adequate diversification and exposure to assets that we believe are going to add value to their return over time.
Right. Okay. So I think that's great. I think that also we in the investment community is constantly talks about like South Africa only makes up less than 1% of the global market.
Absolutely.
So I think that the diversification and investing more offshore is in order. Amika, my next focus is about Coronation Strategic Income Fund. Just now you also mentioned about fixed income. So if I look at the Coronation Strategic Income Fund, which is probably the largest fund in the sector, which has done well for investors over the long term. And if we look at the current bond yield, especially we look at the South African government bond, the yield is really attractive. You look at the 5-year, 10-year or long-term bond that in terms of the yield is north of 10%. And right now, because of the South Africa stance of non-alignment and somehow that deters certain foreign investors, where last week it was in terms of the bond issuance wasn't selling that well. So even though the bond yields are currently very attractive, and does the Strategic Income Fund hold a substantial amount of that? And do you think it's going to work out for investors over the next 12 months? Because if we look at the bond fund return over the last 12 months, even though with an attractive bond yield, it hasn't really reached 10% total return for investors. So going forward, if you look forward for the next 12 months, do you think that kind of a 10% return is going to be realized for investors?
Yeah, so if you look at the fixed income funds or the flexible fixed income funds over the last 3 years, they actually haven't delivered a total return in line with what the yield suggested they should return. And that's because you've had very significant capital movements in the bond markets.
Right.
So this year, like you said, bond yields have weakened, but the more extreme moves happened last year in the big global fixed income sell-off. And then you'll remember 3 years ago during COVID, we also had another big event that drove yields higher, and so prices fell. So unfortunately, despite having a very attractive yield over the last 3 years, your total return has been a couple of percentage points shy of where most investors would have liked these income funds to end up. And so by and large, if you look at the Coronation Strategic Income Fund, the part of the portfolio that detracted the most would have been our duration position, that's our position in nominal government bonds. Now, we still have a decent allocation to nominal government bonds within the portfolio, but we certainly haven't bet the farm. And the reality is those yields are very, very attractive. You know, you could pick up anywhere between 10 and 12% on fixed rate government bonds today. And so there is a large amount of risk premium built into those yields. The market is demanding a very high yield to lend our government money because of, you know, that laundry list of issues that we described earlier on in this conversation, be it greylisting, be it lack of growth, stage 6 load shedding. All of those issues are weighing on sentiment. And so market participants are demanding a very high yield. So if you compare South Africa to other emerging market peers, we compare quite favorably still. And even if you compare to developed markets, our yields are still very, very attractive on a real yield basis. So there still is adequate demand, we think, for these bonds based on yield, but sentiment is definitely shifting more and more negative as we find ourselves with more and more sort of negative news around SA. And there are growing concerns around the fiscus and government's debt accumulation and its ability to repay that debt. But like I said, all of that is being factored in terms of that. So we've had 2 big bond blowouts in 3 years, and this year you've already seen bond yields weaken. However, we also admit that we are closer to the peak of our interest rate hiking cycle, as opposed to being closer to the beginning of these interest rate hiking cycles, not just domestically, but abroad as well. And so we would expect a better return outcome from our nominal bond position over the next year or so, all things being equal. So we think that current yield of around 10% is an adequate proxy for expected fund performance over the next 12 months. And like I said, we keep reinforcing that, that's assuming that we don't get any further big blowouts in the bond market, but we've already had 2 in 3 years. And our bond yields are already so weak at these levels.
Okay. I hope that it works out for the fixed income investors, for the conservative investors. My next focus is in terms of Coronation global markets. You have significant investment expertise pools in this area, and I just like to understand in terms of, given the current geopolitical tensions between Russia and China on one side, and the US and Europe on the other side, how does Coronation position its global funds? If I recall, like last year, when the Ukraine war started, I think everyone was taken by surprise, and obviously that your position in Russia, even though it looks very attractive from the valuation point of view, suffer a paper loss because of sanctions and all the. I know some of my clients invested even directly in the Russian funds, and all that money is right now they cannot touch the money, and the value is on paper is zero. So right now, like 15 months, 16 months down the line, with the Ukraine war, it looks like it's still lingering on. It's not a quick fix yet. How does Coronation position itself, and what about your Russian position? Are you able to elaborate on that?
Yeah, so good question. And I think I can definitely confirm that geopolitical tensions are most definitely something that is of concern. I think one must also acknowledge, though, that these are very unpredictable events, or the nature of geopolitical events is quite unpredictable. And the reality is that if you look at countries like China and Russia, you've got political leaders who themselves are very unpredictable. And the inability to know what is going on in the inner minds of someone like Vladimir Putin obviously creates a very unique set of risks for doing business or investing in countries like Russia or China, for that matter. So we are also aware that these geopolitical events, should they come to pass, or should people's worst concerns come to pass, they are often very, very binary in nature, which means they can go one way or the other. Again, making them very difficult to predict. As I mentioned previously, we never position our portfolios for a single outcome. So we would never position our portfolio based on any view on what will most likely be a very unpredictable geopolitical outcome in any case. There are, of course, a few ways that we try and manage these risks. And of course, there are some harsh lessons learned along the way, like the lesson learned in Russia. But I think we must also take a step back and understand that Russia's invasion of Ukraine was not broadly expected. People on the ground, Russians themselves, do not expect Vladimir Putin to go ahead with this. They're in a reminder of how unpredictable these leaders can be in their decision making. So the way we can try and protect our portfolios are the following. Firstly, we've got to manage the portfolio size in our funds and ensure that we are not overly exposed to any one specific sector or region. Within the Coronation portfolios, we have specific limits to higher risk countries, and we also implement single stock limits within our portfolios as well. So managing portfolio size ultimately becomes a very important risk management tool when you find attractive opportunities in these countries, but they tend to be higher risk countries to make investments in. We also apply higher discount rates when we are valuing what could be perceived as a higher risk investment. So certain stocks in certain jurisdictions have got a higher hurdle rate to jump over before they can make it into our portfolios. And then finally, we apply our minds very carefully to ensure that the companies that we invest in are less exposed to unpredictable government intervention. So you'll remember, going back to the second half of 2021, it was China that was in the news and causing major upheaval in global markets because of their crackdown from a regulatory point of view on education, on tech. And look, with the passage of time, we grow to understand those regulatory changes quite well. And we realize that very often the economic impact to the stocks that we own is much less than the market's reaction to that. But I think that's what we have to try and understand, because these events are so unpredictable. We've got to make sure, even if something does surprise us, that the economic impact of the companies that we own is more limited compared to, a different part of the market. So stock selection becomes ever more important in terms of, investing in countries like China and Russia. But we certainly weren't in a position, when it comes to Chinese investments over the last year and a half, where we called China uninvestable. There were many market commentators that were very fearful, and decided that they weren't going to invest at all. And then surprisingly, last year, China reverses its COVID policy, again, completely unexpected. Chinese economy reopens and everybody loves Chinese stocks again. So again, you've got to be careful of, taking very binary positions in your portfolio against what could be a very short-term market impact. But I suppose when it comes to Russia, you are right. These issues are still with us today. The war is still ongoing. We have the exposure within our portfolios. We've written them down to zero, so there's no more downside in terms of the exposure that we have to Russian assets. So we've got all the upside with no more downside left for investors. But until capital flows are allowed again, until the sanctions are lifted, we're not going to be able to materially trade these exposures. These stocks are trading on the Moscow exchange. We had exposure to stocks like food retail, an oil company, financial services businesses, which are all still credible businesses. They are still operating, they are still trading, some of them quite well within Russia, but unfortunately, we just aren't able to do anything until those sanctions are lifted.
Right. Thanks for the explanation. I think that right now, South Africa is also embroiled on choosing the side because with the upcoming BRICS summit and putting is to come to South Africa. I think that's right now our president is trying to deal with the matter and send delegates to the US and Europe, trying to resolve this issue. I think that we need to see how it's going to affect us South Africans. When should the BRICS summit happen as planned. But let's move on to the last question I have on my list. Sure. We know now that there's a current fad on AI and ChatGPT. Like a few years ago, when everyone has crazy about the meme stocks and cryptocurrency. Now the latest is about AI and ChatGPT. And a couple of days ago, I watched the Apple WWDC event, and they launched their latest the headset, which looks very pricey, $3,500, and it's going to be launched next year. So there's a lot of kind of a technological advancements and AI and ChatGPT. And then now, if we look at the markets, it seems like all momentum investing now, like going into these mega stocks, betting on the Microsoft, Nvidia, and whoever goes into the AI. So, are you invested in these mega stocks, or do you see them as just they will come and go, and you are not interested in these like quick profits?
Yeah. So we do have investments in some of these mega cap stocks like Microsoft and Amazon and Alphabet, and we've been invested in these stocks for many, many years, given their dominance in the sectors in which they operate, and given how quickly they are first to market to embrace new technology and new changes. I think when it comes to ChatGPT and other large language models, otherwise known as artificial intelligence, we actually do believe that this is a significant new development in technology, which will have, and in fact has already had, a huge implication for many industries in terms of efficiency. we think that the ability to converse and instruct in natural language has an enormous range of applications. So it is something we actually are looking forward to in terms of seeing how it develops. We think this will be seen in time as significant an event as the introduction of the internet or smart mobile devices and other industry-defining technologies. Of course, certain industries are more likely to be disrupted than others. And the key will be to see how this tech is implemented within organizations to try and identify where the best opportunities sit. We think it will prove to be an incredible efficiency-enhancing tool for something like rote and repetitive work, and a range of other applications. So one particularly exciting prospect is the ability to reduce the need for specific knowledge to develop and write programs, for example. So with this kind of technology, you won't necessarily need to know the underlying program language, but you can verbally instruct the system in terms of what you want it to do, and it will write the code. So we're quite excited about some of the changes that are going to come. And if you think about it in terms of its disruption or its disruptive ability, the fact that Google, which has dominated internet search for over 20 years, has potentially had its industry, and it's had its industry leading position undermined by this technology is very revealing in terms of, one, how significant this is, and two, how much change can come about as a result of this technology. So I think the one thing we learned about technology is that it is quite cutthroat, it's ever-changing, it's fast-paced, and in order to secure your dominance in any particular industry, you've got to innovate and you've got to embrace all new changes that come through. So we definitely think this is something to look out for, and there are definitely opportunities within some of the mega cap stocks that already exist, that are already moving to embrace more and more artificial intelligence within their businesses.
Right. Yeah. Last week I attended the Ellen Gray event, and one of the speakers, as a portfolio manager, was joking. He said that he's got another 18 months of lifespan as a portfolio manager. That maybe afterwards he will be replaced by ChatGPT or one of these AI. I think that I don't know whether that AI will be so quick to replace portfolio managers or investment professionals, but I think that certainly we watch the development with interest, and I agree with you. Like repetitive tasks, things that that's where through the AI they based on the mining of all the data around the world, and are able to give you certain useful applications or tools. I think that's certainly what as far as I see, I can see how it has helped me in my daily work in some instances. So that's we will continue to learn, and I think the important word here is to innovate. We mustn't just stay as we are, and we need to continue to evolve, so to speak. Yeah. Absolutely. All right, Amika, thanks very much for your time and for speaking to the audience about how Coronation looks at the investment world and how you are positioning yourself, the investing clients' money. And I think that it certainly has been beneficial for all the audience out there. Just from me, thank you. Goodbye until next time.
Thank you, Kevin.